Very good morning, friends. So, the weather in Delhi is pretty good indeed, and I think it's a wonderful weather to study as well. So, we started a journey on Indus 103 that is on business combination. And just to give you a quick recap in terms of what we've been discussing, I had given you basically, first of all, a total of a three-step model in terms of approaching this particular standard. So I gave you the insight that when you approach the standard, there are total three focus points before one can say that yes, we are within the scope of the standard. One is that you've acquired a group of asset. Second is that it is a business. And third is that you get a control over the business of the acquiree. We also went across the concept of the tests which are conducted to identify whether it is a business or not. So we saw the concept of a concentration test. And then we also went across the three element test, which is called the IPO, input, process, as well as an output. After this input of introduction, we started that there are basically, you can say broadly, three kinds of accounting which are suggested in terms of the standard. So in order to understand the accounting, we broadly considered that there is either a related party transaction, which could lead to a common control transactions, which is Appendix C. We're yet to discuss any details on that. And then we said it could be an unrelated party transactions, which could either result in an acquisition accounting or it could result in a reverse acquisition accounting. We started a journey with the concept of acquisition accounting, broadly defining the 7 steps on acquisition accounting. So when you proceed with the acquisition accounting, you've got a sequential of 7 steps to apply. So we said the 7 steps are nothing, but the first 6 steps are basically, you can say indirectly a working note to the 7th step. Because the 7th step involves the acquisition entry. So for this, what you need to do in step 1, identify the date of acquisition, which generally is always explicitly given in the question. The second is getting the accounting acquirer, which is a very crucial step because that would indirectly tell you that is it a reverse acquisition or is it a case of acquisition accounting. So in this particular case, in step number 2, I gave you a detailed chart where the focus points were in terms of identifying that whether the consideration is in terms of shares primarily or is it primarily in terms of cash. And also focusing whether a new company is created for the purpose of this acquisition or not. Then we went to the step number 3, which has got 2 sub-steps. One is the application of Ind AS 12. If you're given a tax rate in the question, you are required to see for all those assets and liability where the fair value, you can say, which is considered the carrying amount for the purposes of Ind AS 12, differs compares to the tax base, and you go to get taxable deductible temporary differences, consequentially a DDL or a DDA. And then in terms of step number 3B, you need to organize the input in terms of all the assets and liability, the list of all the assets and liability, which will feature in the acquisition entry. Then we were discussing the step number 4, and we have partly discussed the step number 4, which is on the calculation of the purchase consideration. I gave you a list of 7 issues, out of which we have discussed the 4 issues with you. So one block we considered DC, CC, that is S, and CC, that is E. Deferred consideration, contingent consideration in the capacity of employee, contingent consideration in the capacity of the shareholder. When it comes to DC, it is a confirmed payment in the future. When it comes to a contingent consideration in the shareholder's capacity, it is a future payment based on ifs and buts, but no service condition. And if it is a CCE, then it is a future payment with bits, ifs and buts, but the condition is a service condition in the future. So we do take the DC in the calculation of the PC at a fair value, which is the present value of the consideration. CCE is not a part of PC. CCS also becomes a part of PC at a fair value. Next, we were making a discussion on the concept of TC, and we said TC, transaction cost, is not a part of PC. Sounds so interesting words. DC, not be part of PC. CC, depends whether part of PC. TC, not a part of PC. Then I think we came to the concept of PHI, that is a previously held interest. So now I'm going to discuss a PHI. I need to discuss a share-based payments and the concept of pre-existing relationship with reference to a purchase consideration. So let's begin the journey in terms of conceptually discussing the PHI, and we'll do some questions on that as well. So let's begin the input with reference to the previously held interest. That's what we call PHI. Part of my step number 4, that is purchase consideration. Previously held interest. You can also call this as a case of step acquisition. It can also be called as a step acquisition. Now, let me, I think, give you a quick summary chart for revision, and then we can do some questions on that. Well, I would say that there are basically two permutation combinations which can happen if it is a case of a step acquisition or a case of a PHI. So let's, I think, create a simple summary chart. So in this particular case, we can say two combinations could occur. One is that there is a conversion of a passive investor into a control situation. Mind the words. A conversion of a passive investor into control, or a conversion, significant influence into control. So two cases are possible. So the case number 1 is a conversion of a passive investor into the situation of a control. Or the second situation could be a conversion of a significant influence into control. So these are the two situations which could occur in terms of step acquisition. Now, what you need to relate is, if it is a passive investment, we are covered under Ind AS 109, and we are switching over to the concept of control. If it is a significant influence, you are covered under Ind AS 28, and you're switching over to the concept of control. So we can say, in this case, the earlier accounting which is being done is in terms of Ind AS 109. So what am I supposed to do? I just need to recall that as per Ind AS 109, this equity investment is either accounted at FPTPL or it is accounted under FPT-OCI NR. So you need to go back and take a decision that as per 109, you were covered under which kind of accounting. So based on Ind AS 109, you could be covered either under FPTPL or you would be covered under FPT-OCI, and that is no recycling, that is NR. So accordingly, one thing is very clear, the PHI is going to be updated at a fair value. And when you go to update it at a fair value, then any fair value gain or loss in the first case enters the P&L. And any fair value changes in the second case will enter the OCI. So it's important to identify the existing accounting, because you are going to update the previously held interest at a fair value. So in both the cases, you need to compare the fair value versus the book value of the previously held investment. Consider the fair value on acquisition date and compare it with the book value on the acquisition date. So whatever gain or loss comes in will be taken respectively at the places. So in the first case, we can say if there is any gain or if there is any loss arising, that will enter the P&L. And in the second case, any gain or loss arising is going to be taken in the other comprehensive income. So as simple and as straight. So you just need to understand the previous accounting and the gain or loss is taken in the P&L or the OCI. And let's also consider one more thing in this particular case. Since it is OCI with no recycling, there would be an accumulated balance in the statement of changes in equity as well. So whatever is the accumulated balance in SOKI in tab number 3 is also going to be transferred in retained earnings. That is a tab number 2. So we will also transfer the accumulated balance, and this accumulated balance is going to be transferred from the tab number 3 of statement of changes in equity to the tab number 2, which is supposed to be retained earnings in this particular case. I think that makes it life simple. So I guess you're able to get the connect very carefully on this, that once you are looking at a passive investor converting into a control, just focus what was the earlier standard. And based on the earlier standard, you are going to just correlate the fact that you need to update the PHI at the fair value on acquisition date. Any gain or loss depends upon the previous accounting. FPTPL, take it in the P&L. And if it is FPT OCI, take it in the OCI. And any accumulated balance in tab 3 shifted in terms of tab number 2. I hope the first input is clear. Let's go to the next one. Now, once we come to the second situation, significant influence converting into a control situation, then again you relate that we were covered under Ind AS 28. And therefore, it was a case of an equity method of consolidation. So in this particular case, when we were covered earlier under Ind AS 28, we were basically applying the equity method of consolidation. So when you're applying the equity method of consolidation, then the life is simple. You need to compare the fair value on the acquisition date versus the book value of this investment as per the equity method. The fair value on the date of acquisition versus the book value which is there as per the equity method, and any gain or loss in this case is going to be transferred in the profit and loss account. As simple and straight. So I think that takes care of a quick summary chart in terms of how the PHI is going to be dealt. Now, there is some very interesting agendas which needs to be taken care when it is a case of conversion from a significant influence to a case of control. And that is, once you applied the equity method, you all know this very well, the application of the equity method involves the debit of the investment and the credit of the P&L or the credit of the OCI. So during the course of accounting under equity method, the company would have already done entries in the past, investment debit, P&L credit, or investment debit, OCI credit, which means even in this particular case, there will be an accumulated balance. There will be an accumulated balance in terms of tab 3 of SOKI. Now, this needs a very important caution because you need to make a scrutiny of this accumulated balance. Because in this accumulated balance, there will be some items which will be a case of recycling, and there will be some items which will be a case of no recycling. We'll do a question also on that. But in this particular case, when you consider, I would say what you need to do in this particular case is go for a scrutiny. Go for a scrutiny of this particular balance, because we need to identify that which element is R and which element is NR. Then based on the element which is R, this is going to be transferred in the profit and loss. And based on the element which is NR, that's going to be transferred in the retained earnings. So I think let me just connect the dots once again on the second case. There has been an examination question on the second case as well, because I think that is the only interesting area. So remember, when it is a conversion of an associate into a control, you've got two focus points. One is the fair value on the acquisition date compared to the book value on the equity method. As per equity method, any fair value gain or loss is going to be taken in the P&L. That's, I think, simple. Updating the PHI at a fair value and the gain or loss is taken in the P&L. But the second most crucial aspect is that when you applied an equity method as per Index 28, there would be some balance in the tab number 3 of SOKI, because you would have done entries investment debit and P&L credit, or investment debit and OCI credit. So we are concerned with all those balances which have been accumulated in tab 3 because of the application of the equity method. So you need to make a scrutiny of all those balances which have been credited in OCI in the past. And after the scrutiny of these balances, you'll come to know which component is R and which component is NR. The component which is R is going to be transferred in the P&L, and the component which is NR is going to be transferred in the retained earnings. I hope, friends, the theoretical revision is clear to you. Then we can start with the practical on this.
Yes, sir.
Wonderful indeed. So let's, I think, take you to a practical illustration. I am carrying questions now at this stage. Let me, I guess, take you to a small little inputs in this case. Okay, I think, let me just take it ahead. Okay, I think I've not taken the question in this sheet. No worry, I'll share the question to you otherwise. Oh, yeah, there is a question. Sorry, there is a question. So let me just crop this a bit. So I hope this is visible enough. Should be, I guess.
Yes, sir. Clear.
Let me just create a little space to write as well. And there is another part of the question as well. So let me just, this is June 2019 examination question. Is this good to go? Is this visible?
Sir, please extend a little bit, sir.
The June 19 question?
Okay, then I think this should be good. We'll change the font later. So good to go, I guess.
Yeah, yes, sir. Good to go, sir. June
Okay,
means
wonderful
it's the
indeed.
COVID time, I believe.
Okay, right. So let's, I think, read this particular question. Let's read the question number 3. So it says Deepak, an automobile group, acquires 25% of the voting ordinary shares of Sean. I think that makes it very clear that there is a significant influence because you get a 25% stake in the company. So this is going to indicate a significant influence. And it says by paying 4320 crores on 1st April 2017. This is the cost of acquisition. Deepak accounts is investment in Sean is accounted using equity method prescribed under Index 28. So since it is a significant influence, goes without saying that the company is doing a consolidation as per equity method. Then he says on 31st March 18, end of the year, Deepak recognized the share of net asset changes of Sean by using equity accounting as under. So he's giving you the history in terms of the accounting as per the equity method Index 28. As I said, investment debit, P&L credit, investment debit, OCI credit. So he's giving you the corresponding inputs on that. So there is a share of profit or loss, so for which we would have done the entry investment debit P&L credit. Then there is a share of exchange difference in OCI and the entry would have been investment debit and OCI credit. And there is a share of revaluation reserve, investment debit and OCI credit. So can I say with all these 3 entries, the investment would have got a debit. So the company would have added all these 3 components as a part of the original cost of acquisition. So he says the carrying amount of the investment in the associate is therefore 4779. This is the original cost of the investment, adding the share in the 3 elements, the profit loss, the exchange difference, and the revaluation surplus. Indirectly, he has given you the inputs in terms of how the equity method of accounting was done. Now, a quick question before we read further. Can I say this exchange difference would have rested by the name of FCTR in terms of tab 3? Am I right? As per Index 21, if there is an exchange difference arising, you would have taken that in foreign currency translation reserve. Am I right?
Yes, sir.
Correct.
Yes.
And similarly, the share in the revaluation would have been taken as a revaluation surplus in terms of tab number 3. Now, we just need to recall that FCTR, as per Index 21, is supposed to be a case of recycling. And revaluation surplus, as per Index 16, is a case of no recycling. So, along with this, we also identify that this is a case of R and this is a case of NR. Let's read further. Then it says on 1st April 2018, Deepak acquired remaining 75% of the shares for a cash consideration 13,500 crores. And we given the fair value of the 25% interest already owned is 4860 crores, and the fair value of the net assets is also given on 1st April 18. So the fair value of the PHI is given 4860. How should the business combination be accounted in accordance with the applicable Ind AS? Now, my piece of advice is when you do this kind of a question, which is a PHI, simply devoted to PHI, you should concentrate in terms of doing, separate entries. First, focus on the comparison of the fair value versus the book value as per equity method and do the entry. Second, make a scrutiny of the other comprehensive income accumulated in the tab number 3. And third, you can concentrate on the acquisition entry as per 103. Go in stages, you don't go wrong. So let's, I think, begin with the first input in this particular case. So I am first looking at the fair value versus the book value as per equity method. So we were to compare the fair value on the acquisition date versus the book value as per the equity method. So I am very clearly given the fair value of the PHI is supposed to be 4860. And if I consider the book value as per the equity method, it is coming to 4779. So what is the difference? The fair value gain in this particular case? 4860 versus 4779. I think it's a difference of 81. So where will you take this difference, in the P&L or will it enter the OCI? I am under conversion of segment influence into a control.
Because already we have in the OCI balance, we need to record in OCI.
No. This is going to be
P&L.
P&L. This is my first element. When you compare the book value as per equity and fair value in terms of significant influence to control P&L. In the first case, passive to control is a different situation. If it is equity to a control, profit and loss.
Okay, sir, got it.
Right. Now we go to the second aspect, and it's time to make a scrutiny in terms of the balances in OCI. So I am given there is a balance in FCTR. So tell me, where are you going to take this balance in FCTR? It is a case of recycling. So am I going to put this in the P&L or am I going to put this in RE?
P&L.
That's
in
right.
P&L, sir.
It is a case of recycling. So that is to the extent of 54. And this is to the extent of 84. Then there is another balance which is in the revaluation surplus. And where would you transfer the revaluation surplus balance considering it is NR?
RE.
It goes to
Retained
RE,
earnings.
So this will
tab
go
number
to
2.
the retained earnings, and that is to the extent of 27.
Tab number 2.
I think that makes life simple when you go step by step. The first is the comparison of the book value as per the equity method, remember, not the cost, versus the fair value. The second is the scrutiny of the other comprehensive income. And finally, we can put the entry, which is the acquisition entry. Now, in terms of the acquisition entry, I am clearly given the net assets on date of acquisition 16,200. So the net asset gets a debit, and the purchase consideration is going to be both what you paid at this stage for 75% and the fair value of the PHI. So when you go to consider the purchase consideration, you need to consider the PHI at a fair value plus what you paid as of now. So what did we pay as of now is given previously. So we paid 4320 crores previously. So we can take this as 4320, and the fair value, the PHI, is 4860. So let's see what is the sum total of this.
9180.
9180. And in this particular case, is there any NCI? I guess there is no NCI. Sorry, this was not 4320. Sorry, this is 13500. That's I've taken the previous acquisition cost, I'm afraid. So the amount paid for the remaining consideration, I'm afraid, is 13500. So 13500 plus 4860, that works out at 18360. Is there any NCI to be recorded in the acquisition entry? I had a 25%, I acquired another 75%, making it
No
100%.
NCI.
No NCI, 100% occurred.
So that's right. So we can comfortably take the balancing figure in this entry, and that becomes goodwill. I think that's 2160 is the balancing figure. That is goodwill. Wonderful question indeed for 8 marks. Super question, I would say.
Where is this 13,500, sir? It is given in the question.
Yeah, here it is, 13,500, what we paid the remaining consideration.
So we are taking both the amounts, sir, originally and the balance also.
Originally will be taken at a fair value. Original will be taken at a fair value, that is 4860. So we need to consider what you've paid today and the fair value of the PHI. The sum total becomes the entire consideration. PHI will be at the fair value, not at the original cost, not at the book value. Right. Right. So,
Excuse me, sir, I have a doubt.
yes,
So there is 378 rupees in PNL account. So what have we done with it?
nothing to be done for that. During the course of accounting under equity method, whatever amount is taken as investment debit P&L credit goes out there. Nothing is to be done. It is only, the concern is only that whatever amount is shifted in the other comprehensive income, that needs a scrutiny. So nothing to be done for the P&L figure. What is gone in the P&L is gone in the P&L for consolidation perspective. That indirectly is already a part of the investment carrying value. So when you are considering the updation of that investment, so you can say that P&L credit is already a part of the book value. So nothing to be done.
Okay, thank you, sir.
You're welcome. Right, friends. So I think this takes care of the first agenda, what we have covered, and that is PHI. Now, coming back to the larger issue of purchase consideration, DC done, then CCS done, then CCE done, then TC done, and then PHI done. Now comes the input in terms of SBP. So let's, I think, give you a quick revision on the on the SBP. So my next agenda in terms of the purchase consideration is SBP, that is share-based payments. That is share-based payments. I'll not recap the logics in this case. We've already discussed the logics in the detailed sessions on this standard. So I'm just going to make a quick summary chart revising the inputs in terms of how the share-based payment impacts the calculations of the purchase consideration. So let's create a summary chart on the different permutations and combination. So in this particular case, when you look at the concept of a share-based payments, I would say there are 3 permutations and combinations. There are a total of 3 permutations and combinations which could arise in terms of share-based payments. So you would recall that when you are looking at SBP, in this particular case, one case is where the acquirer is required to mandatory replace the share-based payment awards. So it's called mandatory replacement. The second situation is where we say it is supposed to be an optional replacement. And the third case is when we say that there is no replacement. So you need to first of all read the language of the question carefully and identify, is it a case of a mandatory replacement or a case of no replacement or a case of optional replacement, and accordingly the calculations will go. So the first thing is to identify, is it a case of a mandatory replacement? That is case one, that it is a case of a mandatory replacement. Or case number two, it is a case of, you can say, optional replacement. Or we can say it is a case number three, which is a case of, so either the acquirer decides that I am not going to replace the share-based payment awards which are issued by the acquiree to the employees. So now let's focus on if it is mandatory, if it is optional or no replacement, what is the element to be taken in the purchase consideration. So let's put it flat. Can I say number one, what do I need to do? I need to get the fair value of the original award. I need to get the fair value of the original award on the date of acquisition. Mind the words, I need to get the fair value of the original award on the date of acquisition and take a proportion of this. So when you take a proportion of this, it is supposed to be vesting period completed. In the numerator, we're going to consider the vesting period completed, and in the denominator, we're going to consider the original vesting period or the total vesting period, whichever is greater. So in the denominator, we need to consider the original, or you can say the total vesting period, whichever is greater. So this is the proportion of the fair value which is considered as a part of the purchase consideration. So I'm not giving you the logics at this stage. That all is dealt in the detailed sessions. So I am just reminding you the key provisions. What is the proportion of the fair value which is to be captured as a part of the purchase consideration? So in this particular case, we take the fair value of the original award on the acquisition date as a percentage of vesting period completed upon the original or total, whichever is greater. So this proportion is a part of the purchase consideration. Would you like to also tell me what would be the journal entry as far as this component is concerned? Because once you insert this as a part of the purchase consideration, then there is another entry which is to be done after the acquisition entry. Remember, you've added this as a part of the purchase consideration. So once you discharge the purchase consideration, what entry would you pass? Anybody would like to give me the entry?
Purchase consideration debit and credit to share-based payment.
Very good. SBP reserve. So we're going to put the entry in this case. The purchase consideration gets a debit and the SBP reserve is going to give a credit at this particular stage. Wonderful. So apart from the acquisition entry, this entry also needs to be done immediately after the acquisition entry. Let's go to the next case. If it is a case of an option replacement, the standard makes it very clear that this relates to post business combination period, and therefore nothing is to be done as a part of the business combination accounting, because we are doing an option replacement. So nothing is to be done, nothing is to be added as a part of the consideration. Therefore option replacement doesn't come, because if it is a post business combination, it is going to be accounted as per Ind AS 102, that is share based payments later. So nothing to do with the business combination per se. Then comes the case when there is no replacement. Can I say in this particular case, the calculations are similar to the mandatory replacement. So in this particular case, again, we will consider the fair value of the original award on the date of acquisition. We're going to consider the fair value of the original award on the date of acquisition, absolutely similar to what we have done in a mandatory replacement. Here again, we need to consider a proportion. So vesting period completed, we can say divided by the original or the total vesting period, whichever is greater. So no changes at all as compared to mandatory replacement. But the only difference is that this is not a part of the purchase consideration. Or you can take it as a part of PC, that's not a problem. And then later something to be done. So tell me, If I take this as a part of the purchase consideration, tell me the journal entry which I will do after the acquisition entry. Like here you said SBP reserve. So where will I take this amount if it is a case of no replacement?
I think we should record the same entry.
No. This is now going to be purchase consideration gets a debit and the NCI gets a credit in this particular case. Because in this case, you are not doing any replacement. So indirectly, you can say this is like you can say shares which will ultimately go to the outsiders and not to yourself. So in this particular case, it'll enter the NCI. So everything is same. If it is mandatory replacement, it is getting credited to SBP reserve. And if it is a case of no replacement, it is getting credited to NCI. Otherwise, the calculation is absolutely similar indeed. So I've just created a short summary chart, just reminding the provisions in terms of SBP. So remember, if it is a case of optional replacement, I'm safe because nothing is required to be done on the acquisition date. If it is a case of mandatory replacement, or if it is a case of no replacement, then a proportion of the fair value is entered as a part of the consideration. Here also you're taking it as a part of the PC, then crediting the SBP reserve. Here also it is a part of the PC, but then you're crediting the NCI. So the only distinction is in terms of crediting SBP reserve or crediting the NCI, rest everything is absolutely similar. Right, friends, I hope I am clear with the summary chart of the share-based payments as well.
Yes, sir.
If not taken as a part of, sir, just a minute. If not taken as a part of PC, you said it is an optional thing. We take it as a part of PC, then in case of no replacement, then this is the journal entry.
Right. But I would insist that, you should always take it as a part of PC so that you can later credit the amount in NCI. Alternatively, if you don't want to take it as a part of PC, then the suggestion is that in the acquisition entry, you take a SBP reserve credit here directly without taking it as part of PC. And here also in the acquisition entry, you increase the NCI without taking the part of PC. But I would say just to keep a track in terms of things, it is better to include it in PC, then put another entry crediting SB reserve or putting another entry crediting the NCI. Otherwise, if you don't want to take it as a part of PC, just ensure that in the acquisition entry, you take SBP reserve. Just ensure that in the acquisition entry, you take an increase in the NCI. Right.
Yes.
Sir, if
Yeah.
in MCQ this kind of a question comes to calculate PC, will we add this NCI portion in it or will not add it?
Well, if I go with
No,
the presentation, what
non-replacement
is
का.
done in the study material as well as in the education material, the preferable presentation is taken as a part of the purchase consideration. So I would say you should take it as a part of the PC itself. Because the presentation which is done in the study material as well is a part of the purchase consideration. So that's preferable. Therefore, I've kept my presentation also correct.
Okay, thank you, sir.
You most welcome. Right, friends. So now I think let's have a look at a question on this area. I think I had put a question on this area. Yes. So we can have a look at the question number 4. Though the heading itself is telling you the answer, but please don't read the heading. We're just going to read and decide whether it is a mandatory replacement or not. It says on 1st April 2014, ABC granted equity settled share-based payment awards with a grant date fair value which is 1 lakh to the employees which is subject to a 3-year service condition. Company XYZ acquires the entire shares of ABC on 1st April 16. How many years have already been passed?
2 years.
That's right. So out of 3 years, we can say 2 years is already completed. And as a part of the acquisition agreement, it is required to issue equity replacement awards to ABC. It says it is required. It is required. So can I say the word it is required is indicating a mandatory replacement? Undoubtedly, yes. So it says
Yes, sir.
it is required to issue equity settled replacement awards And then it says at the date of acquisition, the market-based measure of the original award is given. So you are given the fair value of the original award on the acquisition date is 1,80,000. And then it says the market-based measure of the replacement award is 2 lakh. So this is the fair value of the replaced award. The replacement awards have a 1 year vesting condition. So is there any change in the original vesting period, or does it still continue to be 3? Out of 3, 2 years have already finished, and the new replaced awards have got another 1 year vesting. So
There is
is
no
there any
change, sir.
change in the original vesting period? No.
No, sir.
That's right. So determine the amount attributable to the pre-combination service. Pre-combination service means what is a part of the purchase consideration. Because when you're considering what is pre-business combination, that's a part of the PC. And then it says what is the portion relating to post-business combination, and that would be accounted as per Ind AS 102, that is share-based payments. And then it says where all employees are expected to meet the service conditions. So let's, I think, identify the portion which is pre and the portion which is post. So I would say again, you can do your calculations in a simple 3 steps. Oh my God, not again 3 steps. But it's better to do it in 3 steps. See how. So I'm just going to put the answer out here. This is question number 4. So we'll just organize the input on a 3 steps just to be on a very safe side. So let's organize the data. Step number 1. We're going to first of all consider that what is the pre-business combination portion. Let's first of all organize what is the pre-business combination portion. So we need the fair value of the original award on the date of acquisition. So what is the fair value of the original award on the date of acquisition? I think it was 1,80,000. Into the vesting period completed is 2, and the original or total vesting period is 3. Because in this particular case, the vesting period completed is 2, original is 3, and the total is like 2 plus 1. What is completed is 2, and what is yet to be completed is 1. So remains 3. So this works out, I guess, how much? 1,20,000.
120, yeah.
Then we will consider identify what is the fair value of replaced awards. What is the fair value of the replaced awards in this particular case? And I think that is given to me 2 lakhs. The fair value of the replaced award is to the extent of 2 lakh. And then you can get the portion which is related to post-business combination. So let's now identify the portion which relates to post-business combination. So we can reduce the step number 2 minus step number 1, because we need to ultimately create an SBP reserve to the extent of 2 lakhs itself, and out of which 1,20,000 is taken as a part of the business combination. So we can say out of the 2 lakhs in step 2 minus 1,20,000 in step 1, you need to create another 80,000, that is post-business combination. So the portion which relates to the post-business combination is going to be accounted under Ind AS 102. But this is going to be accounted after the acquisition entry. Nothing to do with this. You know, there is a very interesting chart which is also coming to my mind. Issues related to the purchase consideration, the impact on the date of acquisition, and the impact post-business combination. Do you want me to create a chart after the end of the discussion which gives you a comparative position for all the 7 issues? How do they impact the acquisition entry, and what is the subsequent accounting for all those 7 issues?
Yes, sir.
Yes, sir.
Yes, sir.
I'll give it to you, not an issue. Right, so I think that takes care of the mandatory replacement. Now 6 issues out of the 7 issues are done. So I have given you the inputs on DC as well as the 2CC, ENS, the TC, then the PHI, and then the share-based payments. Now the only input left over is the pre-existing relationship. I think that I'll explain with a practical illustration itself. So no summary chart for that. Let's get on to the practical illustration on pre-existing. I think I've perhaps not put a question here. I'll share it on the screen to you. Let me share a question to you on the screen. that is on the pre-existing relationship. But before that, I think let's do a small little comprehensive question as well. So before I take it further, let me share another question to you on the screen to calculate the purchase consideration. Please have a look at this particular question. So far, whatever we have covered, this question is going to cover all the aspects so far. I am given there is a cash paid which is 3 lakh. I'm given that there is a cash paid in 1 year's time that is 2 lakh. What is this cash paid in a 1 year's time?
Future payment.
Can I call it as a deferred consideration? DC?
Deferred consideration.
Absolutely. We can call this as a DC because it's a confirmed payment at a future period of time. So it is DC. Then he says 10,000 shares in P, which has got a face value of $1 and a fair value, which is $3. So can I say we're going to consider the fair value of the shares issued? Basically, when you consider a purchase consideration, there are basically two elements. One is the cash paid and one is the fair value of the shares issued. Then he says 2,50,000 is to be paid in 1 year's time if S makes a profit before tax. So what is this, DC or a CC?
CC.
That's right. It is paid in 1 year's time provided certain conditions are met. And what is the condition? That the PBT is more than 2 million. Now, by the way, is it a CCS or a CCE? The condition does not involve any service. It only requires meeting certain profit targets.
CCS then.
That's right, absolutely. It becomes a CCS. Then he says there is a 50% chance of this happening. The fair value of this consideration can be measured at, look at the language carefully, present value of the expected value. So my contingent consideration has got a fair value, which is to be taken at the present value of the expected value. Let's not concentrate on that. Can I say there is a 50% chance of this consideration getting paid? So can you tell me what is the expected value of this consideration? Can I say 2,50,000 is going to be paid? There is a 50% chance. Nothing is going to be paid. There's another 50% chance. So can you tell me what is the expected value? There are two possible outcomes.
113625.
1,25,000 you said?
No, I said 1 lakh. I said 1,13,625.
No, I think you're taking the present value as well, I guess. I just need the expected
Yes, sir.
value. Okay, that's great. So the expected value in this case, can I say, will be 2,50,000 into 50% plus a 0 into 50%, taking the weighted average of the two possible outcomes. And then you need to take a present value as well. But where do you take the present value? The discounting rate is given much below. Okay, you already taken care of that. Okay, that's great. Then he says P is required to replace a share-based payment. Is it mandatory or is it no replacement or is it optional? P is required.
Mandatory.
Mandatory.
Because the replacement is there.
That's correct. So then he says by the acquisition date, S employees had rendered the required service for the award but had not exercised the option. So can I say the vesting period is already completed? So can I say I need to consider 100% fair value of the original awards as a part of PC? Is that correct?
Yes.
Because in this particular case, the vesting period is completed. So whatever is the original vesting period, that's already been completed. Then he says the fair value of the award on the acquisition date is 4 lakh and the fair value of the new award or the replace award is given to me is 5 lakh. Then he says the legal fees associated with the acquisition is given. What is this legal fees?
Transaction cost.
That's a transaction cost and that's not a part of the purchase consideration. Then he says wherever required, you need to consider a 10% discounting rate as well. Wow. So I think that makes it all the elements put together. So you want me to retain the question on the screen or can I remove it and write it on the board?
Yeah, you can write it on the board, sir.
Okay, wonderful. So I'm just stop sharing the screen. let me just add the elements. So let me see what is to be taken as a part of the purchase consideration. So one is that we are given that there is a cash to be paid, and one is the shares issued that would be taken at a fair value. So let's just keep adding the elements. The cash paid is to the extent of 3 lakh. So as far as the cash paid is concerned, this is to the extent of 3 lakh. And as far as the shares are concerned, I am given that 10,000 shares have been issued at a fair value, which is 3. So we need to consider the fair value of the shares. That works out at 30,000. Then there is a cash paid in 1 year's time. That is a deferred consideration. So once it says that we're going to pay 2 lakhs in 1 year's time, discount this at the rate of 10%, which is for a period of 1 year.
1,81,818.
Wonderful. 181818.
Yes, sir.
And then I am also given a contingent consideration, which is, of course, in the shareholder's capacity. So we need to take the present value of the expected value. So we'll take the present value, 2,50,000 has got a 50% chance, and nothing is to be paid has got another 50% chance. And we need to discount this again at the rate of 10% for a period of 1 year, because this CC is also going to be paid 1 year from the acquisition date. So I think this is
625.
113,636, I guess. And then finally, we're also given the share-based payments as well. So in terms of SBP, we just consider the fair value of the original award on the date of acquisition, that is 4 lakh, because the vesting period is completed. And as far as the TC is concerned, that is not to be taken. Legal fees not to be taken. Okay, I think that's all what is given as the inputs in this case. So we can get the sum total. 3,30,000, 181818, 113,636, and 4 lakh. This is, I think, 10,25,454. I thought, let's do something different for you. Let's do something question, which is unique, because you might have done already questions from the study mat and the exam kit. So in any case, thought, let's give you something different. Brilliant idea indeed. Okay, now comes the last issue on the purchase consideration before we create that wonderful chart, pre-existing relationship. So let me share another question to you. Just a second. Let me just share a question on the pre-existing relationship. Okay, we had another interesting question on a contingent consideration as well. Maybe we can come to that later, I think. Right, I guess let me share now a question on a pre-existing relationship to you. This is there in the study material as well. So we'll directly solve this question and then create the chart. Here goes the question. So let's, I think, first of all, read this particular data. It says entity ABC acquires entity PQR for consideration of 1 crore. Then he says 4 years ago, entity ABC granted a 10-year license, allowing the entity PQR to operate in Europe. Let me just remind you, can I see if there is a pre-existing relationship that is of 2 types? One is called contractual and one is called non-contractual in nature. Can I see if it is non-contractual in nature, you'll end up recording the fair value of that amount as a part of the acquisition entry. For example, if there is a legal court, if there is a court case against each other, then I will identify the fair value of that particular amount and that will be adjusted in the consideration. But if it is a case of a contractual relationship, then we need to do some more calculations. Now, quick question to you. In this case, when it says that ABC granted a 10-year license, what does this indicate? That this relationship was contractual or was it non-contractual in relationship?
It is a contractual.
Contractual.
Absolutely correct. This is undoubtedly a contractual relationship in this particular case. Then further, I am also given, it says the cost of the license is 2,50,000 and the contract allows either party to terminate the franchisee at a cost of unexpired initial fee. Can I call the unexpired initial fee as a book value? Where it says that you could terminate the agreement at a cost of unexpired initial fee. Can I call the unexpired initial fee as the book value post the amortization? There seems to be quite a silence on that. So let me, I think, tell you definitely yes. Because when I use the word unexpired initial fee, you can see the initial fee which is paid by the acquiring company is going to be treated as an intangible asset in the books of acquiring. And can I say that intangible asset is going to be amortized in the books of the acquiring? So when it says on a termination, you are required to pay an amount which is unexpired initial fee. It represents a book value. Now let's, I think, do one more calculation. What is the life of the license?
Sir, unexpired means it is it look like a security deposit which has to be returned.
No, not that way. You see, let me, I think, first put the position. When ABC gave a license to PQR, is that an intangible asset in the books of PQR at that time?
Yes, sir.
So can I say that being an intangible assets will get amortized over the period of the license? So
Yes,
can I
sir.
say whatever is the book value represents unexpired fee pay, because what he paid initially is the fee. And then when you amortize it over the life of the license, then you call it as a book value or you call it as unexpired fee. It's one and the same thing, synonymous terms. So the word unexpired initial fee is representing the book value of the, you can say, intangible in the books of the PQR.
Yes, sir.
I
Right,
hope
sir.
you got the point. Great.
Right, sir. Right. Sir.
Okay, then also another issue is coming to the mind, and that is if this particular asset is acquired back by the acquirer, can I say it also becomes a reacquired asset in the books of the acquirer? Which
Yes, sir.
means that this is also going to hit my step number 3B as a part of the list of the net assets. You will also record the fair value of the reacquired rights as a part of step 3B. Don't worry, I'll document that. But I thought let's do it with a question because you can relate it easily. So he says that if the contract is cancelled, terminated by either party, you need to pay an unexpired fee plus 20%. Now, let's do some quick calculations. So what is the total period of the license? It's given 10 years. And how many years the license was given back? It was given 4 years ago. So can I say when the license was given at a cost of 2,50,000, the annual amortization would have been 25,000, correct? And since
Yes, sir.
4 years have already passed by, how much would have been the total amortization? 25,000 into 4, that comes to 1 lakh. So can you tell
Yes,
me
sir.
what will be the book value of this intangible in the books of acquiring?
1,50,000.
1,50,000.
Absolutely correct. So he says that the amount to be paid as a compensation is going to be unexpired fee 150 plus 20%. So 150 plus 20% would make it 180. And he's already given the calculations in the bracket. Though that was not required, we could have done those calculations on our own. The settlement amount is already defined that this is what is to be paid if the contract stands terminated. Next. I am given further, it says entity ABC acquired entity PQR because it sees high potential in the European market and wishes to exploit it. Entity ABC calculates that under the current economic conditions and at the current prices, it could grant a 6-year franchisee at 4,50,000. Can I say this is the fair value of the reacquired rights? And if this is the fair value of the reacquired rights as a part of the step number 3B in the list of net assets, you're also going to capture that 4,50,000 as well. Then he says how is the license accounted as a part of the business combination? Okay, so now I think let's see the inputs. I'll document some quick notes on this area as well. So let's first see the pre-existing relationship. So the next element of the purchase consideration is the pre-existing relationship. So let's now make a summary chart. Then I'll solve the question, because I wanted to show you the question just to, get the cap, because sometimes when things are a little more technical, it's difficult to, understand it without an example. So I thought let's first relate it. So let's create a summary chart for a pre-existing relationship. So I would say there will be two inputs which you are going to confront as far as a pre-existing relationship is concerned. Either it becomes non-contractual in nature if there is, let's say, a relationship of, you can say, a plaintiff and defendant, a legal court case going against each other. So one of the inputs would be that it is non-contractual in relationship. The other one is that it is contractual in relationship. Now, the question is, what is the role of this in terms of the purchase consideration? Can I see if it is a non-contractual relationship? My advice is that you put an entry before the acquisition date. Before you do the acquisition accounting entry, what do you need to do? You should put an entry, and that is profit and loss gets a debit and the bank gets a credit. Can I say this is the amount which is the fair value of the liability? So in this entry, let me also tell you that I am indirectly presuming that there is a court case which is done by the acquiree on the acquirer. So this is the entry based on the presumption that there is a court case which acquiree is done on the acquirer. So the acquirer, before putting an acquisition entry, will put the entry profit and loss debit and bank gets a credit, settlement of the amount at a fair value. But this is on the presumption that he's not created any provisions in the books of accounts. But let's say if the acquirer has already created a provision in the books of accounts, then along with this entry, you can debit the provision as well. Correct? I hope you're able to relate to this entry. So I will basically debit the provision already created in the books, make the payment equal to the fair value, and any balancing figure is going to be taken in the profit and loss account. Settlement of a pre-existing relationship. And then the second thing what you need to do is, the purchase consideration going to be increased or decreased by this fair value? It is on the presumption. Acquiree made a court case against me. If the acquiree made a court case against me as an acquirer, so I'm saying, okay, I'll pay you a consideration, including the settlement of the pre-existing relationship. So what should be the PC? Plus the fair value or minus the fair value? I think I'll have to answer that as well. It's going to be minus the fair value. So in this particular case, remember, if it is a non-contractual relationship, before passing the acquisition entry, you need to first of all take care of the settlement of the pre-existing relationship. The profit and loss will be given a debit. The provision will be at the book value and the bank at a credit. So let me, I think, do one thing. Since I've already made this entry, let's give you the different elements. So the bank is going to be recorded at a fair value. The provision is going to be recorded at a book value. And you can say the profit and loss will get a balancing figure. And in terms of PC, whatever fair value is paid for the settlement of the relationship, that will get reduced, adjusted. I'm again putting it very clear. This is the accounting on the presumption acquiree puts a court case against the acquirer. Now let's come to the non-contractual relationship. Can I say again, you will be putting the entry profit and loss debit and the bank gets a credit. But this time, this is not with the fair value. This is the entry which will be done at the lower of the two amounts. This is the entry which is done at the lower of the two amounts. So you need to calculate, number one, that what is supposed to be the amount which you will pay on the settlement. So if you settle, if you terminate, I'll rather put it in the brackets that if you terminate the agreement, if you settle the agreement at this stage, what is the amount am I going to pay at this particular stage? In my example, it is 1,80,000. In my example, it is supposed to be 1,80,000. And we need to calculate what is the book value of that intangible assets. In my example, it is 1,50,000. So in this particular case, what we need to make an adjustment is supposed to be the lower of the two. The lower of the two in this particular case, sorry, not the book value, I'm afraid, not the book value, the fair value. So we need to consider the lower of the two. What is the fair value of this asset? That is 4,50,000. So the amount which is going to be done at the before the acquisition date, the fair value of that intangible assets or the amount paid to settle, terminate the agreement, whichever is less. So this entry will be done with 1,80,000. And then again, the second thing, you are going to make a reduction of the purchase consideration, and that is by 1,80,000 in this example. I guess this is getting a little technical, I think, for many of you. I think most of you are not able to recall the provisions of the pre-existing relationship. Is my feeling correct? I think very correct indeed.
Yes, sir, very correct.
Yes, I could understand that. Anyway, I think you can revise that later, but I'm just trying to recap the provisions in this case. So I think if I just quickly give you the answer as well in this question, can I say this entry will be done with 1,80,000 and then you are going to reduce 1,80,000. And another third thing is, as a part of the list of net assets, that is in terms of step number 3B, you're also going to consider the fair value, which is supposed to be 4,50,000. This is like a reacquired rights. So apart from this, when you consider the acquisition entry, the net assets will also include the fair value for the purposes of acquisition entry. Okay, so this is done. I think I now want to make some chart with you. Now, let's do one thing, friends. Before we do a comprehensive question, because I think the PC is done, I'm still left with the calculations of NCI and the goodwill. So let's, I think, first make a comprehensive chart. So I'm going to give you a very interesting chart. Please try to answer as many questions as you can, because if you can answer majority of the questions, your concepts are going super duper. Shall we do the honors of making a comprehensive chart on the purchase consideration? 7 issues, entries before acquisition, entries on acquisition, entries post business combination, whatever it requires. Let's begin the journey. Please try to answer maximum questions you can. I am creating a super summary chart. I'm not calling it as a summary chart because I've already created those summary charts for individual elements. I'm now creating a super summary chart which will connect all the dots. So let's create a super summary chart at this stage. So I am dividing my chart in terms of various columns. One is I'll discuss the 7 issues related to the purchase consideration. I want to see the impact before acquisition, as well as post business combination. So my focus is very clear. I am looking at these 7 issues relating to the PC. What is done before acquisition, that is acquisition entry, what is done on acquisition, part of the acquisition accounting, and what is done post business combination. So let's put it like this. Let's consider the 7 issues. This is the super summary chart related to the purchase consideration. So we're looking at pre-business combination. We're looking at the acquisition accounting. Does it impact that? And I'm looking at the post-business combination. So please visualize with me. Let's go step by step. Number 1, I am looking at the deferred consideration. Would there be any impact on the pre-business combination? Would you do any entries before the acquisition accounting if it is a case of DC? Of course not.
No, sir, it's not nowhere related to pre. It's only post.
Absolutely. This is not related to the pre. Can I say in the acquisition entry, it is a part of PC at a fair value, which is the present value of the future payment, correct?
Yes, sir. Yes, sir.
Wonderful. So it is a part of PC at fair value, which is equal to the present value of the future payment. Now tell me any impact on the post-business combination. I gave that yesterday as well. That when you're going to consider the present value, what is going to lead to in the future?
We need to divide the interest.
Absolutely, unwinding of discount.
Unwinding discount.
That's right. So I'm putting it as UOD. It'll lead to unwinding of discount, and you're going to put the entry finance charge gets a debit and the DC gets a credit. This can be tested, of course, in simple MCQs. This could be tested even in a small little question as well, because PC is a very important element of this particular standard. And you can get independent questions on this area. So your thought process needs to be very, very clear on these agenda. So this is my first issue, that is DC. Let's go to the next agenda, and that is CCS. That is CCS, contingent consideration in the shareholder's capacity. Any impact pre-business combination?
No, sir.
That's right, of course not. And can I say acquisition accounting, again a part of PC at a fair value? And in this particular case, I'm going to add something more. It's a part of the purchase consideration at a fair value. Now, there is something which I did not say, a question which I did not do, but I think if you want, we can do the question later. But let me, I think, remind you now the inputs. Can I say the contingent consideration could be in the form of cash or it could be in the form of shares? If it is in the form of cash, it becomes a financial liability. And if it is in the form of shares, it depends, it is fixed or it is variable shares. If it is a variable share, it becomes a financial liability. And if it is supposed to be a fixed shares, then it is supposed to be equity instruments. I hope you got the dots clear.
Yes, sir. As per 109.
Wonderful indeed. So we can say that when you take this as a part of the fair value, you also need to consider the classification. You also need to consider the classification at that particular stage. And the classification is that either it is paid in cash or it is paid in the form of equity shares. If it is paid in the form of cash, it is undoubtedly a financial liability. But if it is paid in shares, there could be fixed shares or there could be a variable number of shares which are issued as a part of the CC. And can I say if it is supposed to be a fixed share, equity instrument, and if it is variable shares, it becomes a financial liability. So classification as per Ind AS 32. So this is the classification as per Ind AS 32. So immediately when you consider this as a part of the PC, this should also click to your minds. Now, would there be any subsequent accounting as well? Can I say if it is regarded as a financial liability, as per 109, it is a financial liability at FPTPL, correct?
Yes, sir.
That's right. So if it is a financial liability in this case and a financial liability in this case, it is measured at FPTPL. It is measured at FPTPL as per Ind AS 109. Is going to be measured at FPTPL as per Ind AS 109. So any gain or any loss arising is going to be captured in the P&L. So in this case, a remeasurement will take place and any gain or loss on the remeasurement is going to be transferred in the profit and loss. What about if it is equity instruments, any remeasurements required? If it is supposed to be equity instruments, any remeasurements required?
It will go to OCI.
No. There will be no remeasurements. In this particular case, there will be no remeasurements. It is not an asset. It is supposed to be on the equity liability side for me. So there is going to be no remeasurement if it is supposed to be a fixed number of equity shares.
Yes, sir. For no only liability, no
Yes, if it
remeasurement,
is a
right?
financial liability remeasured FPTPL, equity doesn't require any remeasurement. So this is the impact of CC. So let's now go to the third agenda as well. I thought this chart is going to be quite of help. So let's go to the next one, number 3, where I'm considering CCE, contingent consideration employee capacity. Is there any entry relating to the pre-business combination?
No, sir, as
Of
usual.
course not. And what about the acquisition accounting? Is this a part of the purchase consideration? No. So can I say nothing to be done as a part of the purchase consideration? So what am I going to do in this particular case? Can I say in the post-business combination, do the accounting based on, let's say if it is paid in shares, then can I say it's going to be Ind AS 102? Because if it
Yes.
is an employee, I presume it is a share-based payment. So you would apply Ind AS 102 on the share-based payments in a post-business combination. Right, so the list continues. I hope you've connected with the dots very clear. You should be very clear in terms of what is done pre, what is done on, and what is done post the business combination. Let's continue with the chart. So let's continue with the other issues as well. All these summary charts will help you quick revisions before the exam. You can even add on a few things as you revise. You want to make these charts more comprehensive. So looking at the list of the 7 issues, the 4th issue now, this is pre-business combination. This is acquisition date accounting. And this is post-business combination. Now let's consider the 4th issue in this case. The 4th issue which comes to the mind is TC. Transaction cost. Any impacts on the pre-business combination? No.
No.
And not a part of PC. So what do we do if it is not a part of PC? Immediately
We
expense.
need to expense it.
Wonderful indeed. So we can say it is going to be immediately expensed. It
Never
is going to
included
be
in PC.
immediately expensed, not a part of PC.
Never in PC.
Yes. And then post-business combination again, no impacts.
Sir, I said never include in PC as transaction cost. Never.
Yes, that's right. Okay, now comes the other interesting agenda. That is PHI. Wow. So can I say PHI, any entries pre-business combination?
Yes, sir. We have to do it, sir.
Updating the investment at a fair value according to the chart I gave you, but I'm just going to put it quick out here. Can I say, I would say that there are 2 cases. Either it is a movement of passive to control, or it is a movement in terms of significant influence to control. So there will be a need to update. There will be a need to update investment, that is the PHI, at fair value. So I think let me just quickly remind you the inputs as well. Can I say in this particular case, when it is control, passive to control, the gain or loss is going to be taken in the profit or loss or OCI as the case may be, correct?
Yes, sir.
And can I say if it is a case of a significant influence to control, can I say the gain or loss is going to go in the P&L?
Yes, sir.
And there will be a scrutiny. There will be a scrutiny of the accumulated SOKI, correct?
Yes, sir. If it is
The
a
rest of the
odd,
details you
yeah.
have in the chart, so I'm not putting that, but I think I just put the basic input in this particular chart.
Yes, sir.
Any inputs to be done on acquisition accounting? Once you've done these entries, anything to be done on the acquisition accounting? No. Anything to be done post-business combination? No. So we have just taken care of this particular issue. So this will be taken care prior to, you can say, the acquisition entry, updating the PHI. Right, and then we go on to the other two issues as well. Let's extend the time.
Sir, will PHI, like investment in associate, form the part of PC?
Yes, because PHI includes not only the investment which is passive, but also investment which is signal influence. When you consider the PC, if it is a case of step acquisition, and there are two cases in step acquisition, passive to control or signal influence to control, both are PHI, both the fair value of the components is a part of the PC.
Part of the PC. Thank you, sir.
Yes, you're welcome.
Because
Now let's consider,
sir,
yes.
because it constitutes the cumulative control, which means that already we have 10% control. Now we have 45% control. Then 55%
Correct. So
control.
it's a switch over from one index to another.
Yes.
So the moment it is a switch over from one index to another because of step acquisition, it is a case of PHI. So there are only two possibilities, because you've got a situation below 20% is 109 passive, 20% or more, but up to 50 is a signal influence. So either you switch from a passive to a control, or you shift from a signal influence to control. There cannot be a third situation for a step acquisition, only two.
So in simple terms, we are closing the previously held investment and we are moving into the controlling position.
Absolutely. Moving from one index to another. That's right.
Right. Okay, sir.
Wonderful. So let's now continue the next two issues as well with the same blocks. So I'm looking at the 7 issues: pre-business combination, acquisition date accounting, and post-business combination.
I think next issue is SPP.
Yes, right. The 6th issue is supposed to be, I think the 6th issue. Yes, the 6th issue is SBP, share-based payments. Any impact on the pre-business combination? On the share-based payment, any impact on pre? No. Can I say for the acquisition accounting, there are 3 cases. One is it is mandatory. Can I say one is that there is optional?
No
and one is
replacement.
that there is no replacement. Can I say if it is mandatory, part of the PC, and the entry later, though on the acquisition date, PC debit, SBP reserve credit. So let's take the column, is it a part of PC? You tell me, is this a part of PC if it is mandatory?
Yes, sir. It will be part of
Yes.
PC.
And in case of optional, part of PC?
No, sir.
No. And if it is not replaced, can I say then also part of PC?
Yes, sir.
So in this case, you are going to put the entry PC gets a debit and SBP reserve gets a credit.
Correct. Right, sir.
What about option replacement?
No entry.
Can I say no entry at this stage, but post-business combination, you would apply Ind AS 102 share-based payments?
Yes, sir.
And if it is, again, not a case of replacement, then the entry is PC gets a debit and the NCI gets a credit. But there is no subsequent accounting in this. Sorry, there is going to be subsequent accounting in this case as well. Can I say here, you need to account for the post-business combination. Remember, we got in the 3rd step, you took the difference between 2 and 1, the amount which is relating to the post-business combination. So can I say even in this case, Ind AS 102 will apply to the post-business combination fair value?
Yes, sir. In our example, 80,000.
That's right. And similarly, in this case also, can I say I'll apply Ind AS 102 to the post-business combination portion? So this will be, you can say, the remaining fair value. So in all these cases, the post-business combinations would also arise in these particular cases.
Yes, sir.
Wow. And then comes the next agenda, and that is pre-existing relationship. So we've got a pre-existing relationship in this case. So as you're doing independent questions on these areas, or when you're doing a larger questions on this area, this chart will definitely help you a lot in terms of connecting all the dots. Because trust me, step number 1 and step number 2 is not a big deal. Step number 3 is crucial. Step number 4 is crucial. 5 and 6 is not a big deal. I think if you get a hold in terms of the list of net assets and the hold in terms of PC, 90% battle of the standard on acquisition accounting is done. Reverse acquisition is different. Common control is different. That's addition. Okay, so on the pre-existing relationship, entries to be done on pre-business combination. Yes, of course. If it is a pre-existing relationship, then entries will definitely be done before the acquisition date itself. Settlement of those existing relationship will be done. So can I say it depends upon whether it is non-contractual or it is contractual in nature. So just to put you the basic inputs, though we've already created a chart for that. Can I say if it is non-contractual in relationship, you need to first of all put the entry profit and loss gets a debit, the existing provision, if any, gets a debit, and the bank gets a credit. Can I say this is with the fair value, this is with the book value, and this is the balancing figure?
Yes, sir.
And in terms of contractual also, you'll put the entry profit and loss gets a debit and the bank gets a credit with what amount? Can I say
Sir,
lower of the two amounts?
yes, sir. Lot of two
Put
amounts.
that lower of the two. I think you can refer the chart. What was the lower of the two? Settlement amounts and the fair value. So you need to
Fair value.
consider the settlement amount and the fair value, whichever is less. Any impact on the acquisition accounting? Any impact on the acquisition accounting?
Yes, sir. We need to reduce the PC to fair
Wonderful
value on
indeed.
the.
So you need to reduce the purchase consideration in both the cases. So we reduce the purchase consideration in both the cases with the amount which is the fair value in this case, and in this case, the lower of the two amounts gets reduced. Anything else?
We need to add this asset value in the net asset.
Very good. So apart from this, you also need to do another thing as well. So in the net assets, you need to take the fair value of reacquired rights. You need to take the fair value of the reacquired rights in this case. Okay, and that's it. And I think nothing to be done in specific on the post-business combination as well. I think this gives me a summary chart of all the inputs related to the issues of purchase consideration. I know this took time, but I think this was very necessary to connect all the dots and give you a summary chart of all the issues related to PC. Okay, I hope you were able to connect all the dots in this chart.
Yes, sir. Thank you, sir.
You're most welcome. Okay, so now I think this is done. Now let's go on to the next agenda, and that is the step number 5 and 6. So we can do some comprehensive questions after the break on that. So step number 4 gets a closure. Now we are going to the next step, and that is step number 5. The step number 5 is pertaining to the calculations of NCI, that is non-controlling interest. And I think I like to connect certain dots at this stage. So as far as the NCI on the date of acquisition is concerned, you know the standard has given you two choices, either a fair value or a proportionate share in the net assets. So in terms of the NCI, the company gets a choice of either considering the NCI at a fair value, or you would consider what is called proportionate share. What is called proportionate share in net assets. That is what we call in short as PASNA, proportionate share in the net assets. Whatever is to be done, that input will, of course, be very clearly given in the question. So one of the two methods would be applied, and the question will give you the inputs. So in terms of fair value, what do you consider? You consider the number of shares held by NCI. It is the number of shares which is held by NCI, can I say, into the fair value per share. By the way, just for clarity of thoughts, is this the fair value per share of the acquirer or the acquiree? Just in case to get the clarity. So when you consider the fair value per share, is it the fair value per share of the acquirer or is it acquiree? Acquiree. Because you're looking at the shares in the acquiree, the number of shares held by NCI in the acquiree. So into the fair value per share of the acquiree. So if you're given the fair value per share of the acquiree, that's also an indication that you are required to apply the concept of fair value. And if it is a case of PASNA, you would take the net assets as per step 3. I can say step number 3B, and multiply this with the percentage held by NCI. Multiply this with the percentage held by NCI. Now some quick questions to you, just to, I think, go ahead. If you're considering the NCI at a fair value, the goodwill which you're going to get is full or partial. And if you're going to consider NCI at a PASNA, the goodwill you're going to get is full or partial. Would you like to give me inputs? If you consider the NCI at a fair value, is it going to result in a full goodwill or a partial goodwill?
I think full goodwill, sir.
That's right, absolutely. So this will lead to the calculation of goodwill being full. And in this particular case, the goodwill is going to be partial, and this definitely has an impact on impairment testing, which you will see in consolidation later. Because we need to be very careful. If the NCI is supposed to be at a fair value, the goodwill is full, and the impairment of goodwill is borne by the parent and NCI both. But if it is supposed to be a PASNA, then the goodwill is partial, and the impairment of goodwill is only borne by the parent company. The share is not borne by the NCI. Right, so that is on step number 5. Now let's, I think, look at a quick inputs in terms of step number 6. In terms of step number 6, we are calculating the goodwill, and there is going to be a simple and straightforward calculations on the goodwill. So what we're going to do in terms of goodwill, we will take the purchase consideration, which is already available in step number 4. And to this, we are going to add the NCI on the date of acquisition. Can I say that is already available in step number 5? So you need to add the PC with the NCI, and once you get the sum total of this, you need to compare this with the net assets at date of acquisition, which is available in step number 3B. That's data is already organized, and you're going to get the goodwill or the bargain purchase gain. So let's consider that in this particular case, if this value is X and this value is Y, the possibility is that X is greater than Y, or the possibility is that Y is greater than X. Can I say if X is greater than Y, then that means it is goodwill. And if it is the other way around, it is called a bargain purchase gain. It is called a bargain purchase gain, or you can call it as a capital reserve. Call it as a capital reserve or a bargain purchase gain. So I think step number 6 is not at all technical, just a mathematical computation. Now, once all the 6 steps are done, it is just organizing and putting that information in the acquisition entry in step 7. So step 7, you've already done. So I'm not putting that. Step number 7 is simply putting an acquisition accounting entry. It is simply putting an acquisition accounting entry, combine all the dots and get the acquisition entry. So I think that takes care of my inputs in terms of all these 7 steps on acquisition accounting. I think we're in a comfortable position now to do a question with you. So you want me to do a simple question or directly take you to a bigger, larger question, which contains almost all the aspects of all the 7 steps put together? So what do you say? Shall we do a comprehensive question? After the break, I guess we can maybe take a break first and then start with a comprehensive question, or you want me to do a smaller question? I think I want to do a big question.
Yes, sir. We'll do big question.
Wonderful indeed. Okay, so I think let's first give you a break. So I think let's refresh the minds and then I'll start with a comprehensive question applying all the 7 steps. Please enjoy a break.
Okay, sir. Thank you.
Thank you. Haji. Relax your minds. So now I think we are ready to go to a comprehensive question on the acquisition accounting, looking at the application of all the 7 steps we have done. Let's, I think, take you to a comprehensive question.
Okay, sir.
Right. So I think this is one of the questions in the study mat as well. A similar kind of question has come in the exams also. So as we read, we're just going to connect the dots as well. So we'll keep relating into which particular step is the inputs relating. Good to go, I guess. Visible?
Yes, sir. Visible, sir.
Okay. I think we can keep it till this space.
Yes,
More
sir.
than
Now,
this, I think.
yeah,
Now it's
yeah.
fine.
Now, absolutely fine.
Wonderful indeed. And I think I can zoom this part as well. Okay, so now let's first read the question. So as we go to read the question, I would also advise that when you read the additional information, try to connect that this adjustment relates to which particular step, so that you'll be very clear as we proceed with the steps. We know that, okay, this is to be seen for this particular step. I am given the balance sheet of Professional and Dynamic on 31st March X2. And I'm going directly to the additional information. And it says Professional acquired 70% shares of Dynamic. So we're given that the company Professional acquired 70% shares of Dynamic on 1st April X2. This is the balance sheet on March X2 prior to the acquisition, by issuing its own shares in the ratio of 1 share for every 2 shares of Dynamic. And the fair value of the shares of Professional Limited is given at the rate of 40 per share. I'm just thinking aloud as I read the inputs. Can I say, number one, there is no new company which is created. And number two, the consideration is primarily in shares. So what I'm thinking is that we should calculate a pre and a post business combination percentage to identify whether it is a reverse acquisition or not. Is my thought correct?
Yes, sir.
Yes.
Right, sir.
Absolutely. Then he says the fair value exercise resulted in the following. The fair value of the property, plant, equipment is given, and Professional also agreed to pay an additional payment as a consideration that is higher of the two. It says 35 lakhs and 25% of any excess profits in the first year. So you're going to pay 35 lakhs or 25% of the excess profit, whichever is greater. So can I say that you will definitely land up paying 35 lakhs? Because if you're saying that I will pay 35 lakhs or 25% of the excess profits, whichever is greater. Now, let's say if 25% of the excess profit is below 35 lakhs, will you pay 35? Yes. And if, let's say, 25% of the excess profit is more than 35, let's say it is 40, then you're going to pay 40. So can I say in either of the cases, you will definitely pay a 35 lakh rupees of amount. Is that correct?
Yes, sir. DC.
That's right, absolutely. So we can say 35 lakhs becomes a DC. And can I say it is only the excess, that is 25% of the excess profits minus 35 lakh, that represents the contingent consideration. Because whether you will be able to get the excess or not is dependent upon whether the excess profits are going to be enough where you get that excess money. So we can say it's a blend between a DC and a CC, because 35 lakh is going to be paid irrespective, that's DT, and the excess, which is excess over 35 lakh, becomes a CC. And is this CCS or is this a CCE?
Yes. Yes.
It is S, because the conditions attached is in terms of profitability. Then he says after acquisition over its profit in the preceding 12 months made by Dynamic. This additional amount is due after 2 years, so we need to discount it at time value money. Dynamic has earned a 10 lakh profit in the preceding year and is expected to earn another 20 lakhs. So can I see if I consider the excess profit in the first year? So can you tell me what is the excess profit in this case? They've earned 10 lakh in the preceding year and they're expecting to earn 20 lakh rupees. So can I say the excess earnings in this case is 10 lakh? So 25% of 10 lakh works out at 2.5 lakh. So do you think the contingent consideration is likely to be paid?
Yes, sir.
No. No. Because you are paying 35 or 25% of the excess, whichever is greater. So can I say the excess profit is 10 lakh and 25% of that excess is 2.5. So when you compare 35 lakhs and 2.5 lakhs, you're going to pay 35 lakhs only. So the contingent consideration is not going to be payable. And I think it was this reason that he's not given you any fair value of the contingent consideration. So we're not going to consider any CC. Then he says, in addition to the above, professional also agreed to pay one of the founder shareholder a payment of 20 lakh provided he stays with the company for 2 years. What is this? A payment of 20 lakhs if he stays with the company for the next 2 years.
CCE.
Absolutely correct. It is a CCE because this payment is contingent upon the fact that he stays with the company for the next 2 years. So this is not a part of the PC. Then he says Dynamic has got certain equity settled share based pay. That is original awards which got replaced. So when it says it got replaced, is it mandatory or is it optional? Got replaced means it is mandatory in nature. That's right. By the new awards issued by professional, as per the original term, the vesting period is supposed to be 4 years, and on the acquisition date, the employees have already served 2 years of service. But he says, as per the replaced awards, the vesting period is reduced to 1 year. So can I say the original vesting period is 4? Would you like to tell me the total vesting period? 2 years have already passed and you're telling them to work for another 1 year. So what is the total vesting period? Can I say 3?
3 years.
So we'll consider that's right, 4 or 3, whichever is greater. Then I'm given the fair value of these awards for the original and the replacement awards. This is going to enter in the purchase consideration. Dynamic has also got a lawsuit pending with a customer who made a claim of 50 lakhs. Management estimates the fair value of this liability to be 5 lakhs. Can I say this is a contingent liability which is got a fair value? So this will be a part of the list of net assets step 3B, correct?
Yes, sir.
Absolutely. And then we're also given the applicable tax rate as well. So the moment you see a tax rate, what comes to your mind?
TTA or TDL?
Wonderful indeed. And then it says you're required to make an opening consolidated balance sheet of professional on 1st April acquisition date, and we are given a 10% discounting rate. Though I think this question seems to be a little bigger, but I think if you ask me frankly, it's a very, very easy question. It's one of the comprehensive questions, but I think if you go systematically step by step, absolutely easy. Now, what we're going to do as we progress with each and every step, just concentrate on the issues relating to that step. So let's, I think, add on the 7 steps. So let me put the question number. This is question number 7. So let's begin the input. Question number 7. Let's go step by step. So we're looking at the very first step, number 1, that is date of acquisition. Am I given the date of acquisition directly in the question? Yes.
Yes, sir. First, we need to identify the acquirer, accounting acquirer.
Yeah, but first we said date of acquisition, right?
Okay.
As per my steps, I think. Either way, that doesn't make much of a difference actually. Okay, let me just also open the question in front of me to proceed. Okay, So first of all, I guess we are given at the very start that professional acquired shares on 1st April X2. So that is the date of acquisition. Done. Now we go to the step number 2, and the step number 2 is getting that who is the accounting acquirer. So we need to identify who is supposed to be the accounting acquirer. So we know the key points that in this particular case, we know that there is no new company created and the consideration is primarily in terms of shares. So let's organize the data.
Yeah,
Now, if you
2:1.
look at the inputs, 1 share is given for every 2 shares. So let me first
2:1.
organize the number of shares of professional and the number of shares of dynamic. So let's see the balance sheet and identify the number of shares in the balance sheet of both the companies. So do you have the question in front of you? Or you want me to show you the questions side by side? It's in the study mat.
No, I don't have questions, sir. I'm just
Okay, so I'll just keep showing the key inputs out here. So I guess if you look at the balance sheet of the company, we can identify the number of shares. The shares of professional is 10 each and dynamic is 100 each. So can I say this makes it a total of 50 lakh shares? And this is a total of, sorry, this was going to be, yes, 50 lakh. And this is, I guess, 4 lakh shares, correct? So we've got 50 as well as this is going to be 50 and this is 4 lakh.
sir. What is the value? It's rupees in lakhs or rupees in thousands, sir? About
This is all in lakhs.
okay.
So we can consider the number of shares in terms of professional. We identified is 10 rupees per share, so it comes to 50 lakhs. And this is supposed to be 1 rupee per share. It comes to 4 lakh. Now I am given the input in the question that we are going to issue 1 share for every 2 shares held. So let
Which
me
means
consider what is the number of shares to be issued.
2:1.
That's right, 1:2. So number of shares to be issued is 1 against every 2 shares held. So can I say 4 lakh? First of all, you need to consider 70% because we did not acquire all the shares. So we need to consider 70% because professional acquired 70% shares in dynamic. So when you apply the ratio of exchange, first see the shares acquired is 70% and we are issuing 1 share for every 2 share. So let's see the number of shares issued. I think it's 1.4.
Yes, sir. 1.4.
Correct. So this is 1.4 lakh. Now, to be on a very safe side, I would like to calculate the percentage pre and the post business combination to see that it is not a case of reverse acquisition. So if I consider the percentage, can I say Professional Limited had all the shares of their company? So we can say the shareholders of Professional were having 100% stake of the company pre business combination. So can I say once the combination happened, now what is the total capital base of this company? Can I say we issued another 1.4 lakh shares? So the
Yes, sir.
capital base of Professional becomes another 1.4 lakh. So let's see what is the percentage post business combination. I think that comes to 97.3%.
Yes, sir. 97.3%.
So we can see that there is a dilution, but can I say the shareholders of Professional continue to be in control of their company? So can I say the legal and the accounting acquirer is common? So this
Yes, sir.
implies that the legal and the accounting acquirer is.
It's same.
So once we made this analysis, we can say the acquirer is supposed to be Professional Limited. So I made a little detailed presentation so that we give the clarity to the examiner that yes, we know that since a new company is not created and the consideration is primarily in cash, we are consciously deciding that what is the status pre and post business combination to decide that it is not a reverse acquisition. Great. So now I think we can go to the step number 3. What is the step number 3? What is going to be the step number 3? Oh my God. Applying Index 12, that is step number 3A, and then step number 3B, getting the list of the net assets, correct?
Yes, sir. Getting list of net
We
assets.
consider, right, we consider the application of Index 12 before we make the list of the net assets. Now, look at the question and identify which items are to be considered in step number 3A. So let's have a look at the additional information. I am given the point number B1. Is the fair value of PPE going to trigger the concept of a deferred tax asset liability, considering a tax rate is already given in the question? Undoubtedly, yes.
Yes, sir. 30
And
percentage.
apart from this, let's see, is there anything else which will also impact the deferred tax calculations?
Yes, sir.
I guess the point number E, which is talking of a contingent liability having a fair value of 5 lakhs, I think that would also result in a deferred tax implication. So in step number 3A, we will organize a small little chart. So in order to calculate my deferred inputs, let's create a column for particulars. Let's consider the book value, which is as good as the fair value. Let's consider the tax base so we can get the temporary timing difference. And this timing differences will result in either a DTA or a DTL. So let's, I think, organize the input. So we've got one item that is PPE. So what is going to be the book value, which is the fair value? So I think I'm just picking this from the question. My fair value is supposed to be 350 lakhs. And what about the tax base? What is the amount which I'm going to consider the tax base? Should I consider the book value in dynamic as a tax base?
Yes, sir.
Absolutely, because in this case, the original book value becomes the tax base for me. So the PPE in the balance sheet is appearing to the extent of 500. So we take this 500. So let's fit in this tax base at 500. So my tax base is greater than the carrying amount. Is it a taxable or is it a deductible temporary difference?
Tax base is greater than. Then, sir, in this case, we need to create the liability.
The tax base is more than the
1 minute. We need to increase the asset, right? We need to create the asset. TTA.
Right. So this becomes a deductible temporary difference, right?
Yes, sir.
And therefore, this is going to result in a DTA. So let's multiply this with the tax rate as well. I guess the tax rate is given to me at the rate of 30%.
30%, 45 rupees. 45.
So that comes to 45. That is my DTA.
Yes, sir.
And I think next item we are given is the contingent liability. And as far as the contingent liability is concerned, the book value, or rather I would say the fair value, is 5 lakh. So what about the tax base of the contingent liability?
0.
So in this particular case, we can say when you're calculating the tax base of the liability as per Index 12, how do you get the 0? Carrying amount minus the future deduction. So carrying amount is 5 and the future deduction is 5. So 5 minus 5 is 0. I hope you thought of the same, right?
No, sir.
I thought as much because when you said 0, I thought that shoot it out so fast. So that's the reason I thought, let me explain. Because when you're calculating the tax base of the asset, it is a future deduction. When you're calculating a tax base of a liability, it is the carrying amount minus the future deduction. So the carrying amount being 5 and the future deduction is 5 because when you pay the liability, you get the deduction. This is going to be 0. So the carrying amount is greater. So what do you call this difference as?
Sir, we need to...
The liability. This is, remember, a liability with a carrying amount more than the tax base.
Sir, in this case, we need to TTA, sir.
Yes, it is again deductible temporary differences. 30% on this 1.5 becomes a DTA. So in this case, both the asset and liability resulted in a deferred tax calculation. So that works out at 40. Okay, now with this, I think we're ready to go to the step number 3B, wherein we need to organize all the assets and liabilities at a fair value and also keep into account that there might be certain assets liability not in the balance sheet but to be captured. Is there any such item which is not in the balance sheet but is to be captured in the list?
Yes, sir. We need to capture share payment as a
No, that's a part of PC.
Okay,
I
okay,
guess
okay.
I'm making references to the amount of contingent liability, not in the balance sheet of the equity, but is going to be a part of the acquisition entry at a fair value.
Yes, sir.
So let's organize the step number 3B. And now we need to organize the list of the net assets. So we'll look at the balance sheet of professional. Keep looking at the items. So I think I'll just show you the items, then I'll just directly pick them up. So can I see in terms of the assets and liabilities in the balance sheet for the list of net assets, you got to consider the PPE at a fair value, which is of course 350. We're going to take the investments, inventory, then trade receivables, cash and cash equivalents, as well as other assets. On the liabilities, we're going to consider the long-term borrowings. We're also going to consider long-term provisions as well as a deferred tax liability already there. And we're going to consider the short-term provisions and the trade payables and also consider the contingent liabilities as well. I think let's scrutinize if anything else is there. So we'll take the PPE at the fair value and the contingent liability. I think apart from that, I guess nothing is given. And of course,
Yeah, we
the
need to
DTA,
yeah,
the
DTA.
DTA identified in step 3A also gets inserted in the list.
Yes, sir.
So let's, I think, organize the list. So let me pick up the information from the question. So if you go step by step, trust me, it's very easy. So PPE has got a fair value that is 350. The next item in the balance sheet is investments, that is 100. Everything should be taken at a fair value, but I think except PPE, we're not given any fair value. The next we are given the inventories, that is 150.
Yes, sir. Then trade receivable 300.
Trade receivable is 300.
Cash and cash equivalent 100.
Cash and cash equivalent is 100.
Others 230.
Others is 230. So I think that's all on the asset side.
Then TTA we have to put.
Oh, yes, we need to add the DTA in step number 3A. So let's take the DTA 46.5.
Then we have to put liabilities.
Correct. So that is long-term borrowing is 200.
Yes, sir.
I think I'll just put it on the other page. It'll become messy. So I think first we can just add these assets. If you can just give me the sum total of the assets so far.
1 minute, sir. 350, 100, 150, 300.
1276.5.
Yes, sir. 1276.5.
Correct. So let's continue with the list. So 1276.5. So that becomes the total assets, and then we can reduce the liabilities as well. So on the liabilities, we've got the long-term borrowings, that is 200.
200. Then long-term provision 70.
That is
Then
70.
deferred tax 35.
DDL is 35. Then
And
short-term
next,
borrowings 150.
150. Trade payable 300.
And anything else to be taken as a part of the list?
No, sir.
Contingent liability.
Contingent
That is
liability.
5.
Yeah,
Correct.
5.
Right. So this will give us the inputs on the net assets now. Is it coming to a total of 516.5, is it?
Sir, 516.5 after reducing the total asset.
Okay, wonderful indeed. So this is the step number 3B done, the list of the net asset done. Now let's go on to the next input. That is step number 4. So what do we do in step number 4?
Purchase consideration.
That's right. And we've got a total of 7 issues to be kept in mind as we're looking at the purchase consideration. So I will,
Yes.
irrespective in the question, they're all 7 issues or not, but at least once we make a walkthrough, we'll never go wrong with the PC. So we'll keep looking at those 7 issues.
Right, sir. Actually, I mixed this PC with step number 3 earlier.
Okay. So let's consider the purchase consideration. First, I think we need to consider the shares issued or the cash given at a fair value. So I think we've already calculated the shares issued. I think it was 1.4 lakhs, I guess. And what was the fair value of Professional Limited? I guess the fair value of the share was 40 rupees per share. So let's multiply this with 40. We get the purchase consideration.
1.4 lakhs. Yeah,
So
plus
that's
into 40.
56.
Yeah, 56 lakhs, sir.
Correct. So this is 56. And then I think let me at least pen down my 7 issues so that we can just keep a track. Every comprehensive question, you can just, look at those 7 issues. Though in the exam, you may not write down all the 7 issues, but I think for the time being, I want to look into the issues. So is there a deferred consideration? Yes. It was, I think, 35 lakhs.
Yes, sir.
And that was, I think, payable 2 years later. So we discount this at 10% for 2 years.
35 lakhs.
28.93.
Discount rate.
That's the present value of the DC. Then
Okay, sir.
is there a CCS? Yes, it was there. But I guess we are not given any fair value because 35 lakhs or 25% excess profit, whichever is greater. So there was a CCS, but in the absence of fair value, nothing taken. Then I think CCE was there. It's given, but CCE is not to be taken. So we're given the payment, which is given to the founder shareholder. Then next, number 4, we are looking at TC. Was I given any TC in the question?
TC.
No, I think there is no TC which is given in the question, otherwise also not taken. Then we need to consider PHI. I think there is no PHI also given in the question.
Yes, sir.
But there is a share-based payment.
Yes, sir.
So I think let's go back to the share-based payments on the question. So let's have a look at the point number D. So we are given that there is an equity settled share-based payments and the total vesting period is 4 years, out of which 2 years already passed by. And you're given the original award fair value and the replacement award. So tell me, how much are you going to consider as a part of the PC?
2.5.
That's right. So we can take this 5 lakhs and 2.5, or is it going to be 2 periods over and now it's going to be 2 by 3, right?
Yeah, only one period is remaining. We have.
Right. So whichever is greater, sorry, whichever is greater. So that's right. 2 by 4. You're right. 2.5. Correct.
Acquisition date has been reduced, not by, reduced to. So this
Yes,
is not.
but in any case, we need to consider whichever is greater. So it remains 2 by 4. So fair value of the original award is 5. Vesting period completed is 2. Original or total, whichever is greater. So this is reduced to 1. 2 years already over. Another 1 year to go makes it 3. So original or total, whichever is greater. That's 2.5. And then is there any pre-existing relationship defined? I don't think so. So we are not given any pre-existing relationship.
No,
But we
sir.
get the purchase consideration as well. $87.43, I think, is the purchase consideration. Right? Okay, so I think that takes care of the step number 4 as well. Now we go to the step number 5, which is NCI. So next is the step number 5, which is on the NCI. So are we given any instructions regarding the NCI calculations to be done at a fair value or at PASNA? I think I am not given any information whether it is to be taken at fair value or not. So in the absence, it would be, of course, at PASNA. So we'll take the NCI at PASNA. So let's see what is the net assets done. My net assets is 516.5. And we've got a 30% stake for the NCI, I think, because 70% belongs to the
Yes, sir.
parent.
Yes, sir.
So 30% would mean,
It's 154.95.
correct. So 154.95 lakhs is the NCI. Then let's organize the step number 6 as well. And step number 6, we need goodwill. And that's
Yes,
again
sir.
going to be a simple mathematical exercise. Take the purchase consideration, to which you add the NCI, compare this with the net assets, and you get the goodwill or the capital reserve. Let's see what it comes. So purchase consideration already computed, 87.43.
Yes, sir.
NCI is 154.95. $242.38, and the net assets is 516.5. So are we getting a goodwill or are we getting a capital reserve bargain purchase gain? $274.12. So is this goodwill or bargain purchase gain? Capital reserve?
Net asset is greater, then it is a bargain purchase.
Correct. So capital reserve or a bargain purchase gain. Right. So step number 6 is done. Now the question is not asking me the entry, it is asking me the opening balance sheet of professional. But I think for that purpose, we'll put the entry. So let's put the entry in step number 7 as well, and then we'll make the balance sheet also. So step number 7 is just organizing the data, which is the acquisition entry. So I'm just going to put the entry in short net purchase consideration gets a credit. Can I say instead of the purchase consideration, I should technically be recording investment credit? Correct. I'll tell you something more later. But I think instead of saying PC, it should be investment credit. I'll give you the logic also very shortly on that. Then we've got the NCI credit, and we're getting a capital reserve credit. So let's, I think, just fit in the data. The net assets is 516.5.
Yes,
The
sir.
purchase consideration is 87.43. The NCI
Yes.
is 154.95. And the capital reserve is 274.12. We'll just see is the entry tallied, though it should, undoubtedly.
So generally, how it is possible, the gain will be more, sir.
Distress sale. So if it is a distress sale, then there is a possibility. If I know you want to sell and you are in dire need of money, I am going to, take things at a very cheaper value from you. I'll take advantage of your personal situations. Okay, so this is the acquisition entry, and I think, yes, the entry is well tallied, so that takes care of the acquisition accounting entry. But the question is not done. The question is asking us the balance sheet of professional, and before I make the balance sheet, I want to first tell you something very interesting at this stage. I am just thinking, vouch me. Imagine this is the T-shaped balance sheet. Let's say this is the balance sheet of Professional Limited. This is the balance sheet of Professional Limited. And this is the separate financial statements. And let's say this is the balance sheet of Professional Limited. which is supposed to be the consolidated financial statements. Can I say the separate financial statements will be containing an investment? Is my thought correct?
Yes, sir.
Absolutely correct. Can I say if you want to convert this separate financials into consolidation, you add the Ind AS 103 acquisition entry, insert it in this particular balance sheet, and you will be able to get a consolidated financial statements on the date of acquisition. Is my thought correct?
Right, sir.
Absolutely. So we can say Ind AS 103 indirectly is acting as a bridge between, you can say, the balance sheet, which is a separate financials and a consolidated financials. So what will happen? That this investment will disappear. Indirectly, this investment will disappear. So that was the reason of saying that you should credit the investment, because when you're going to give a credit to the investment will disappear. And what will happen in its place? Can I say the net assets will get inserted? You can say the capital reserve will get inserted and the NCI will get inserted. So basically, the replacement of the investment by the net assets, by the capital reserve and the NCI, and that gives you a consolidated balance sheet on acquisition date. So 103 indirectly acts as a bridge between, you can say, separate financials and the consolidated financials. Keeping this in
Yes.
mind, now
Yes,
let's
sir.
make the balance sheet. By the way, is the balance sheet given in the question? Is it supposed to be after considering the acquisition entry, or is it before considering? Not this acquisition entry, I mean the acquisition of investment. Remember, that is given on 31st March and the acquisition happened on 1st April. So is the balance sheet a professional incorporating the investment made in dynamic or excluding the investment made in dynamic? Undoubtedly excluding, because you are given the balance sheet of professional on 31st March. Acquisition is on 1st April. So I think let's do one thing. Before I insert this acquisition entry, let me do something. Let me just make an extract balance sheet kind of a thing. Can I say the entry is going to be investment debit? And what is going to be credit? I am now looking at the entry in the separate financials. So not the acquisition entry, a normal acquisition of the investment. So let me go back and I think illustrate this point to you. Can I say the entry for acquisition of investment will be investment gets a debit, share capital gets a credit, share premium gets a credit, DC gets a credit, and you can take SBP reserve gets a credit. Is my thoughts correct?
Correct, sir.
Absolutely. So let's do one thing. Let's, I think, put this entry so that we can easily, take this balance sheet with this entry and this entry. So investment was how much? 87.43, I think. Equity share capital, share premium gets a credit. Deferred consideration gets a credit. And you can take SBP reserve gets a credit. So I think the equity share was to the extent of how much? 1.4 lakh shares with a face value, I think 10, that's 14. So can I say 56 minus the face value? The rest 42 becomes a premium. The DC is, what was the DC? SBP reserve was 2.5. DC was how much? 28.93, is it? 28.93. So now if I want to make a consolidated balance sheet with a complete clarity, I would say the balance sheet of professional with this entry is the base. Incorporate the acquisition entry, you automatically get the consolidation. So let's see how it works. So let's now make the consolidated balance sheet as well. So we're making the consolidated balance sheet of professional on the date of acquisition, that is on 1st April X2. Okay, so we'll keep looking at the plus and minus to make this balance sheet. Let's begin with the asset side of the balance sheet. So we've got the non-current assets. So first of all, we've got a PPE. So technically speaking, when you're making this entry, don't look at the balance sheet of Dynamic. When you're making the consolidated balance sheet, please don't look at the balance sheet of Dynamic. You need to consider the balance sheet of Professional, incorporating that investment entry, and just insert the acquisition entry. So let's see, what is the PPE for Professional? I think 300. What is the PPE in the acquisition entry? I guess 350, which is the fair value, right? So this works out, I guess, 650.
Yes, sir. 350 is a fair value plus
So
300,
I'll
right?
just keep a little space. This is 650. Then I think investment, which is given, is that investment in Dynamic 400 or is that outside investment? Is the investment in the balance sheet of Professional investment in Dynamic or is it outside? Remember, this balance sheet is on 31st March.
Outside.
Outside. So we're going to consider that investment of 400 and also the investment in the acquisition entry, that is 100. That makes it 500. That's all on the non-current assets. There was no goodwill, otherwise we would have taken that. Then let's take the current assets. So we've got the inventories.
250 plus 150.
That's right. So in the balance sheet, it is 250, and in the acquisition entry, it is 150. That is 400.
Trade receivable.
Yes. Then we get the financial assets. That is trade receivable.
450 plus 300.
That's 450 plus 300. In the acquisition entry, that is 750. And then there is cash and cash equivalents.
Yes, sir. 200 plus 100.
200 plus 100, that makes it 300.
Yes, sir. Next, others.
And we're given the other current assets.
400 plus 230.
That's right. Anything else on the asset side?
Assets
There is a
we need
DTA.
DTA.
But
We
I
need
think
to
we
add.
can maybe set off the DTA DTL for presentation, but that would be a presumption that you're indirectly considering that they can be offset. So I think on a safe side, I can, maybe show them separately or net it off. So is the DTA bigger or is the DTL bigger?
TTL trigger, sir.
Yeah, DDL is bigger, so we can set it off later. So I think that takes care of the asset side of the balance sheet.
Sir, even the set off against the same class of deferred asset and liability only set off. If it is the
Yes.
same legal,
Because
same
unless,
situation. Yeah.
yes, unless the provisions of Index 12 is met that they are arising out of the same tax jurisdiction, you cannot set them off.
Yes, sir.
Absolutely. So I think we're going with the presumption that yes, they can be set off. So I think this is 3230. That is the asset side of the balance sheet. Now I think let's go on to the liability side of the balance sheet as well. I'll take it here itself, equity and liabilities. So now we need to be careful on the equity section, because in the equity section, there has been an increase in the share capital for the investment entry. So
Correct, sir.
share capital is 500. And I think what was the increase? 14, was it?
Yes, sir. 14.
So that is a part of the investment acquisition. Next, other equity.
Other equity we have to consider full.
Yes, so other equity, we've got three elements. One is the other equity in the balance sheet. Let's take it as retained earnings. Then there is a capital reserve. Then there is a share premium as well.
Yes, sir.
So other equity is appearing at 810. And the capital reserve was how much?
Capital reserve. Yeah. On the purchase consideration, I have to see.
274.12.
Right, 274.12. And security premium, I think share premium was 42 in the investment acquisition entry. So what is left is the SBP reserve that would also be entering out here.
2.5.
That's 2.5 because SBP reserve is also part of this. Or maybe you can make a separate working note for the other equity and then take a combined figure, but I've not done that. And then I think least we forget, we also need to take NCI
Yes, sir. NCI.
because NCI would also be part of the equity section itself. So what was the NCI?
54.9.
54.95.
154.
Okay, 154.95. Right, so I think the equity section is done. Now let's consider the liability section. So non-current liabilities. So long-term borrowings. The long-term
250.
borrowings is, I think, 250 plus 200.
Yes, sir.
That
250
makes it
plus 200.
450.
Yes, sir. Then long-term
Long-term
provisions.
provisions.
50 plus 70.
That's right, 50 plus 70. And DC is supposed to be payable after how much time?
Which one, sir?
DC, deferred consideration, was payable, I think, 2 years later.
Yes, sir.
Yes, sir. Yes, sir. 1 year later.
Yes, 1 year later. So that means it is current in nature. So if it would have been non, then we would have shown it out here. Now let's consider DTL. So deferred tax liability after netting off the asset. So DTL is 40 as well as 35. And what was the DTA? 46.5, I think. So this is 28.5 liabilities. And then we can continue with the current liabilities as well. I'm just using the space out here to add the current liabilities as well. So in the current liabilities, we have first of all the short-term borrowings. That's I think 100 as well as 150. That's 250.
Yes, sir.
Then there is a DC, least we forget what was the DC. Then we can take trade payables. And I think there was a contingent liability. So I can add the contingent liability in the trades payable itself, or maybe show it separately. Let's not merge it. Creditors would be different. So let me
5
show the
lakhs.
contingent liability. So contingent liability was 5.
5.
DC was how much?
28.93.
Sorry, missed it out.
28.93.
28.93. And then the
Sir,
trades payable is 250 as well as 300. That's
sir, this is
550.
after 2 years, sir.
No, this is DC is payable after 2 years or 1 year.
After 2 years, it is long term, I think.
Oh, so then it is non-current. That's what I asked earlier. So I got the opinion that this is payable after 1 year. So then
Sir,
show
1
the
year.
DC
Sir,
in non-current.
1 year from the acquisition date. It was mentioned
It's
on the
2
presentation.
years.
Okay.
Okay, let me just check.
Point number D.
It says this additional amount is due after 2 years. It's 2 years. 28.93. Now let's see. Hopefully the balance sheet should tally, I think. Yes, it is tallied. 3230 is the total of the balance sheet. Wow. So I think that was not a very tough question. I think if you proceed systematically, then I think it should not be much of an agenda. I think so. Okay, so I think this comprehensive question gets done. Maybe we can now steal some time to do that one questionnaire, which I said was on the contingent consideration. I think let's do that question with you. So let's do another question with you that was on the contingent consideration. I'll have to share it, otherwise, I think. Okay. I'll have to probably share that question to you. I'll just share it on the screen. So I'll share this in 2 bits and pieces. This is there in the study material as well. A very interesting question indeed. I'm sharing that on the screen to you. I left out this question. Yes, I think Ravi has raised his hand. Yes, Ravi, please go ahead.
Sir, one into you have passed, sir, investment account debit to, that is, I couldn't understood, sir.
Okay, the entry which I did in the books of the separate financials, right? Are you talking about this entry, right?
Yes, sir.
Okay, I'll just put that once again. You see, in the separate financials, can I say you are basically putting a normal entry for investment acquisition, nothing which is related to 103. It's a normal acquisition. So let's say, for example, a professional acquired shares from the shareholders of Dynamic. So the entry will be investment debit, share capital credit, correct?
Okay, sir. Okay.
So that's what I did. That, I picked up the purchase consideration. This is in the separate financials. Investment gets a debit. So whatever is the forms of payment, I've taken a credit of all those forms of payment, share capital, DC, whatever is the forms of payment. So this is only for the purpose of separate financials.
Okay, sir. Okay.
Right.
Understood.
Normal entry, which you do in normal, even in terms of AS 13 normal entry.
Sir, one thing more, sir. Sir, what is the logic of removal of investment account, sir, in consolidated balance sheet, sir?
You see, the basic idea is that when you present a consolidated financials, you need to treat the other company's assets liability as your own, because Ind AS 110 requires that when you present group accounts, the subsidiary is to be presented as if it is a part of a single entity. A separate financials would show investments, but in a consolidation, you're saying that we are a part of the same group. So in order to reflect the investment, we remove the investment, and indirectly the investment gets replaced by share in net assets and goodwill. Because if you notice, indirectly, when you are going to remove the investments, what is coming is the share in the net assets and the goodwill or the capital reserve. So it's an indirect representation of the investment, but in a different format. Because consolidation means I want to show the strength in my balance sheet that that company is under my control. So this is also investment, but you can say investment presented in a different format.
In FS, it will remain same, sir.
Yes, separate financials, the investment continues. It is only for consolidation, investment gets eliminated, and what takes its place is the net asset share plus the goodwill, capital reserve, whatever the case might be.
Okay. Thank you. Thank you.
You're welcome. So let me just share the question back to you. So we're looking at this one question which I missed out when I was discussing the contingent consideration with you. Let's have a look.
Sir,
How should contingent consideration payable in relation to a business combination be accounted on initial recognition and subsequent measurement? So I think I've already put that in the chart, but let's do a little small question on that. It says on 1st April, A acquired 100% interest in B. As per the terms of the agreement, the purchase consideration is payable in 2 tranches. So the main question now comes on the second part. So we are now looking at that the consideration is payable in 2 tranches. So let me share the second component, second part of the question to you. So it says, number 1, an immediate issuance of 10 lakh shares in A with a face value of 10 rupees per share. Is this DC or CC, or is this shares immediately given?
sir, this is share immediately given, sir.
Correct. So this is not DC, this is normal issue of shares. So we'll take 10 lakh shares into the fair value, whatever will be given below. Then he says a further issuance of 2 lakh shares after 1 year if the profits for the first year exceeds 1 crore. What is this?
Conditional.
And is it CCE or is it CCS? There is a condition of profits increasing a certain amount.
CC, yes, sir.
As that is absolutely correct. It is S because there is a payment made 1 year later, and based on ifs and buts without a service condition, it is CCS. My question now is this CCS a financial liability or equity instrument by virtue of Ind AS 32? I am issuing a total of 2 lakh shares. That means it's supposed to be a fixed number of shares. So can I say it is going to be an equity instrument? Is my thought correct?
Yes, sir. Equity instrument. Because
And
it's a fixed thing.
would there be any remeasurement of these particular shares post the balance sheet date? I mean, post business combination? Of course not. Remeasurement of equity instruments issued will not be done. Then he says the fair value of the shares on the date of acquisition is 20, and further, the management estimated that on the date of acquisition, the fair value of the contingent consideration is 25 lakhs. Now, this is one part of the question. Then there is another part. It says continuing the same pattern as is indicated above, except for the number of shares to be issued after 1 year is not fixed. If it is not fixed, does this contingent consideration become a financial liability as per Ind AS 32?
Yes, sir. It's a variable for fixed.
Yes, it is going to be variable number of share. It becomes a financial liability. Now tell me, are you going to do a remeasurement on the balance sheet date? Is the subsequent remeasurement going to be taken on each balance sheet date, FPTPL, financial liability?
Yes, sir.
Undoubtedly, yes. So it says, rather, A agreed to issue variable shares with a fair value of 40 lakhs after 1 year if the PBIT exceeds 1 crore. Now, let me just organize the data. So I've already incorporated this as a part of the initial things, but I thought I'll just do this question. So this is on the contingent consideration. So this is the example from the study material on contingent consideration. So let me put it like this. So we've got 2 inputs in this particular case. So I am looking at when the company is issuing fixed number of shares, then what is the status? And the company is issuing variable number of shares, then what is the status? So do I need to show you the question, or can I just directly fit in the figures? So we'll take the fair value of the shares issued, and that is common to both the cases. So we are given the inputs. So I am given there is an immediate issuance of 10 lakh shares, and the fair value of the shares is 25. So the immediate issuance of shares, there are 10 lakh shares, and the fair value is 25. So this comes to 250 lakhs. Can I say this is going to be common because this is a part of the PC in any case? Now we are considering the contingent consideration which is paid in the shareholder's capacity. So in this particular case, we are given the fair value of the consideration is 25 lakhs. Can I say even here, the fair value is 25 lakhs. So the purchase consideration, of course, remains the same. There is no change in terms of the purchase consideration. Whether you say it is a fixed number of shares or it is a variable number of shares, but the basic input which I want to, connect at this particular stage. So when you're giving the fixed number of shares in this case, it becomes an equity instrument as per Ind AS 32. Because we are going to classify them as equity instrument as per Ind AS 32. And can I say there will be no remeasurements? There will be no remeasurements as per Ind AS 109. I hope I'm making complete sense. So there are 2 things which I want to prove in this particular case. The moment you're saying it is a fixed number of shares, then in that case we are saying it is classified as an equity instrument for the purpose of the balance sheet presentation as well. Remember, if you've got to make a consolidated balance sheet on the date of acquisition, it is going to be presented as equity instrument and not as a liability. And there will be no remeasurement subsequent to the date of acquisition. Now, if you say that there is going to be a case that it is a variable number of shares, can I say it becomes a financial liability as per Ind AS 32? It becomes a financial liability as per Ind AS 32. And can I say it is going to be measured at FPTPL as per 109? It will be measured as per fair value through profit and loss account as per Ind AS 109. So can I say we are also given the information that at the end of the year, the fair value of this liability is risen to 40 lakhs. Can you give me the entry for the change in the fair value from 25 to 40? Anybody would like to give me the entry that if the value at the year end in this case became 40 lakhs, what will be the entry which will be done at the end of the year? Okay, I think I'll have to answer that as well. So profit, yes.
P&L to financial liability.
Correct, absolutely. So profit and loss gets a debit, there is a loss, and the financial liability gets a credit that is to the extent of 15 lakhs. So I've
40
already
lakhs
put
minus
that
20
in the chart. That this, was already incorporated in the chart, but I missed out that particular question. So thought, let's practice this out as well. Right, friends. So I think that takes care of the comprehensive input in terms of the acquisition accounting. So we have done all these 7 steps with the questions within those 7 steps as well. I think the main crucial steps, as I said earlier, is the step number 3 as well as the step number 4. I think step 1 and 2 is not a big issue. Step 5 and 6 is just a mere computation. I think you need to get your expertise done in terms of the step number 3 and 4, arranging the list of the net assets, including the deferred tax implications, and then looking at the 7 issues in terms of purchase consideration. Once you get that, then I think it's not a big deal at all. Right, friends. So I think that is done. So let's see if you've got any questions to ask, because I think I may not get enough time right now to do a fresh new question with you. Any questions on your mind? Otherwise, I'll tell you the agenda, which is going to be there for tomorrow, day after.
Sir, my query is that we have done the consolidation balance sheet on the previous question. Whether the consolidation procedure also recommended by business combination 1 or 3?
No. In fact, Ind AS 103 only defines the acquisition entry. The main consolidation will always occur as per 110. In case one wants to get the consolidated balance sheet on date of acquisition, 103 can help you to get only a consolidation on date of acquisition. Subsequent consolidations will never be as per 103. So 103 can only help you to get a consolidation on date of acquisition. Any consolidation done thereafter will be as per 110 only. But whatever process we are following in terms of doing the consolidation on acquisition date, the principles, of course, we are following is 110. The 103 nowhere tells you that, what is how the consolidation is done. It only focuses on the acquisition date, you can say entry. It is only that we understand that, if you insert that entry within the separate financials, the product is the consolidation acquisition date only.
Right, sir. Thank you, sir.
You're most welcome. Right, friends. Anybody else has got any questions on that? We've got another 5 minutes to go. Anybody else has got any questions? Okay, then let me tell you the agenda for the next class, because next class we'll wind up the concept of Ind AS 103. So we've got now 2 more agendas to go. One is the discussion in terms of reverse acquisition, wherein I need to do 2 very interesting questions. One is a case where a new company is not created, and one is a case where a new company is created. So we're going to handle 2 questions on reverse acquisitions. And then comes the concept of a common control transactions as well. In terms of common control transactions, it's, I think, a pretty easy accounting indeed. Since I want to do this first, then there is one very comprehensive question which is given in the study material. But of course, I think picking that question can eat away a lot of time. So what I'm going to do, I am going to only discuss the agendas related to this. So I have a small little request that, in the next session, if you can come prepared with the revisions of acquisition accounting 7 steps, that's going to be very helpful. Because there is one question which is given in the study material, which is a very comprehensive question, typically pertaining to the concept of step number 3B. Because we've done questions in terms of focusing on the step number 4, that is a purchase consideration. But that one beautiful question which is there, which is also including a step acquisition as well, it's there in the study material, which has got a plethora of issues relating to the calculation of step 3B. So I would like to spend some time, if I get that, to explain you some inputs on that. I may not solve that question, but I'll definitely, if I get time, discuss the agendas relating to step 3B in that particular question. Right, friends, so I think that's all seems to be the journey for the day. So unless you've got questions, then I think it's time to say goodbye to you.
Sir, my question is,
Yes.
Sir,
Yeah, please go ahead.
Sir, I'm a little confused with in case of service payment, non-payment.
But your voice is getting cracked. Can you please come again?
Sir, in case of service payment, non-replacement, why NCI created, sir? My question is.
In case of why NCI is credited in the acquisition entry?
No, sir. SBP, non-replacement.
Okay, in case of
SBP,
non-replacement, why do we credit NCI as a part of the purchase consideration? Is that the question, right? Okay. Now,
Yes.
consider this, that there is an acquiring company, and the acquiring company has got certain ESOPs. Now, in terms of these ESOPs, the acquirer says, I don't want to replace. He says, I'm not replacing. Now, tell me one thing. Once these ESOPs are converted to equity share, who gets the share? The parent or somebody else?
Somebody.
Somebody else? And who is that somebody else? NCI. Got my point? Because if the parent says, I am not replacing, so at the end of the day, once the acquiree is going to issue shares against ESOP, the share capital of the acquiree will definitely go up. But those extra shares are not going to the parent company, but they're going to the outside NCI. Therefore, what we're doing, we are increasing the NCI at this stage, because indirectly you can say they're more like a potential shares, which is increasing the NCI at this stage. Did you get the answer, beta?
Can I make one request?
Yeah, please.
Sir, if we can do one session on the financial instruments revision only for a small session, if you have the time permitting. I mean, later on, after doing the consolidation, one session just for a quick revision for all the concepts taken on one day, 1 hour or 1.5 hours, just basics, going through revising it, not just doing it, not doing any questions, sir.
Okay, we need the permission of the Board of Studies for that. So I think Mr. Ajit is there. I think he'll probably take your request further, because accordingly the planning would be done. So I can't give any commitments from my end on that.
Correct, sir.
Yeah.
Thank you.
Thank you very much indeed. Right, friends. So I think that's all for the day. So thank you very much indeed. See you in the next class on Wednesday. Thank you. Bye-bye. Take care.
Thank you,
Thank you,
sir.
sir.
Have a
Thank you very
wonderful day.
much. Thank you. Same to you. Anji, thank you. Same to you.